Hello everyone and welcome to another episode of the Zerodha Educate podcast. I'll be hosting today's session. My name is Prateek Singh and I run learnapp.com, where you can learn from the brightest minds in the world how to invest. So do check out learnapp.com. Now, since February, there has been a sharp sell-off in the markets as the coronavirus pandemic spreads throughout the globe. And as we record this, Nifty is down 25%, while the mid-cap and small-cap 100 indices are down by 30% and 40% respectively. Think about that. Now, this is the sharpest fall in the market since 2008. If you see that period, it took almost a year for the markets to fall about 50%. But now we've fallen very quickly, and that's why this time is a lot different than 2008. You might be worried about your investments. So we decided to talk to some really smart people who've seen various cycles in the Indian markets to give you some perspective of what to do and what not to do. In conversation, I have Kalpen Parekh, the president of DSP Mutual Fund. Kalpen has 2 decades of experience in the Indian markets, and he was previously managing director at IDFC Mutual Fund. He also served at Birla Sun Life, ICICI Prudential, and he began his career at L&T Finance. Now, we had actually done a session with Kalpen sometime back when there was some volatility. So you should check out that link. We've put it in the notes below. So please enjoy my conversation with Kalpen of DSP Mutual Fund. Hi, Kalpen. Thanks for doing this.
Hi. Thanks, Pradeep. Thanks for having me over.
So my first question is, for the lay investor, he has no clue what's happening in the market, right? So just give me a 10,000 feet view. What is happening?
Okay, Pradeep, there is no concept called as lay investor in my view. There are investors who make money and there are investors who don't make money.
Right.
I think that's the only differentiation that one should have in mind because the labeling of lay versus sophisticated, retail versus institutional is actually should right. Coming back, what's happening right now is a fact that markets which were cruising like a smooth plane are now encountering very turbulent weather,
right.
And the turbulent is on account of the fact that broadly the economy in India and economies around the world have been grappling for growth for many years.
Right.
And, there was reasonable hope that various policies by individual governments and central banks in the world would help in fast-tracking that growth. And in anticipation of a better future in terms of growth, stock prices were inching up or cruising up over the last 5-6 years.
Right.
And there was a little bit of hope in that as well. See, investing is all about hope for the future.
Sure.
And, while markets were hopeful and because of which prices were, cruising upwards, this hope has got delayed or for the time being shattered because of this COVID virus. Because what it does is the scare that it has created globally and the fact that it has been announced as a pandemic which can really infect and affect lakhs and lakhs of people. To prevent that, various governments are coming out with lockdowns, like what India also has announced very decisively 2 days back. Now,
Yes.
What does a lockdown mean? A lockdown means that, for our safety and for the safety of everyone around us, we all remain in one place. But it also means that a lot of speed of businesses and work of businesses slows down. And when businesses slow down, economies slow down, profitability of companies slow down, or even in case of weak companies, profits can turn into losses, which in turn can affect employment, which can affect job creation, which can affect money in the hands of consumers. So India has always been known as a consuming young economy. But if that story gets delayed or broken up because of this pandemic and because of the chain that I explained, profitability can take a knock, sentiments take a knock, and investors stop spending because right now we will all be probably fighting for survival till we get clarity of how this pandemic is being controlled. So so primarily what's happening is markets are now discounting the future. So just 3 months back, markets were discounting the future in a rosy way, in a
Right.
positive way, in an optimistic way. Now the the same market is discounting the future in a pessimistic way and saying that the profits of corporate India, if they are 100 rupees right now, they will unlikely be 100 rupees in the course of next 2 quarters. They will probably drop to 95 rupees or 90 rupees instead of growing from 100 to 110. Typically, that's the growth rate. Instead of growing, it might stagnate. Whereas as a market, we were giving it a higher expectation and a higher value and a higher price, but that price is no longer justified now because we expect profits to slow down. And hence, market has very, sharply seen a fall in prices to the extent of 30% to 50%, depending on sectors and companies. And this is coinciding with a similar trend in the rest of the world. So there are two things, fundamentals and flows. So fundamentals are looking weak right now because of the event that has happened and a lockdown that we've just entered into. It's been just 2 or 3 days that the entire country is sitting at home, and we are trying to optimize and continue to work. But, we have the luxury of using these digital tools and continue with our work. But we are not the only part of the core economy. A lot of core economy, factories, workshops will go through slowdown. So that is the fundamental. The fundamentals will slow down for quite some time in the near future. But the second part, which is flows. So globally, a lot of money has been, chasing the rest of the world because in the last 12 years after the global financial crisis, the US Fed started cutting rates and, printing a lot of currency. That money has been floating around every part of the world. So even in India, if you take the Indian stock market, roughly 20 to 25% of our stocks are owned by these foreign investors. So when they face a similar lockdown in their countries and their flows turn volatile, and in the last 4 weeks, there is huge amount of volatility in currencies around the world, in interest rates and bonds everywhere, in the derivative markets across the world, in commodities everywhere, oil prices have crashed. So all of this is interlinked. So when flows and fundamentals both go against you in the short run, you can have these sharp price corrections. And that is what we are going through right now.
Makes sense. I actually had an interesting follow-up question on this. Now, you've been in the markets for more than 2 decades now, which is a long time. You've at least seen 3 or 4 full cycles in this. So market crashes have happened before. Tell me, what's been similar that you see now versus other market crashes? What are the similarities that you see?
Yes, so, I have, like you said, I started my career in the fund management business in 98. And the first 2 years were euphoric years of .com. And I'm telling you the similarities of what preempts a market crash. What preempts a market crash is that everything looks rosy, everything looks euphoric, everything looks extremely positive as if the world is, going to be a great place forever. And stock markets discount the future very aggressively. So in 2000, all tech companies went to euphoric highs, and then there was a crash. Markets crashed very quickly by 40-50%. But after that is the more painful period where they go nowhere for the next 3-4 years. So price correction is still easy to accept. Time correction is more challenging. It is like when stock prices are in a lockdown and for next 2-3 years they go nowhere. We are used to looking at them every day, and if they go nowhere, it makes us restless. So that was how the correction happened. Then I've seen the 2008 crisis, which was a very large, excess created in infrastructure companies around the world, energy companies, capital good companies, where the world was growing at, 5% growth rate at the entire world. India was growing at 10% between 2004 to 8. And we assumed that this is the normal. We assume that the 10% growth rate of the GDP can be extrapolated forever. Actually, if you take out those 5 years, we've never grown at 10%, except in 2004 to 8. So otherwise, our growth rates have been between 5% to 7%, and currently much lesser than that. So, and then the global financial crisis happened because of the subprime bubble. And, all world economies are connected nowadays. They were connected then, they are more connected today. Prices fell by around 60% world over and in India within a year. It took roughly 1 year or 15 months for prices to come down. And then very sharply in the next year, prices bounced back also. And then for 4 years, it went nowhere. So the period between 2008 to 14 was a period of zero returns for Nifty, for example. Now, what is different this time? Again, what is the same this time is, just before this crash happened, euphoria around asset classes, equities, everything has been at a high. Interest in equity is at an all-time high in India compared to its past history. Number of investors investing has gone up significantly. Campaigns of mutual funds being great products all over the place. So many startups which have evolved saying that, you should invest in equities and mutual funds. So basically, there's a lot of demand for an asset class, typically in the peak of the cycle. Now, the correction has been the fastest. That is something which is unusual about this cycle,
right?
Where the correction of 40% happened within 3 weeks.
And it was almost a year, I think, right? I think 2008 took 9-10 months to happen.
Yeah. So it's very fast. And why is it very fast is because the world is more connected. Data moves, very fast. The moment the Fed in US makes an announcement, in the next half a minute, an American trader gets that information, a European fund manager gets that information, and an individual investor based in Mysore or Bangalore also gets the same information. So information speed has been at its peak in this cycle. It used to take a couple of days for people to understand what was happening in 2000 or 2008 and then process it. Today, things move very fast. Today, we are one world. The distinction of countries and geographies has broken down. So if anything is happening in US in terms of markets, the same information gets processed in real time by fund managers, analysts, traders, brokers, investors in India, and they react very fast. Pressing a button is all it takes. So we'll see. I think that is going to be the order of the day, where speed will be fast. And also in the last 10 years, the growth and emergence of very large pools of passive money in various asset classes, where if certain price bands are broken, they have no choice but to sell. So a lot of those things are also happening globally, and it's after effects here in India.
Yeah, makes sense. I think a lot of ETFs people are investing as well, and I guess the ETF guys, when they invest, they don't look at price. And now when the market's falling, they just start the sell order, and it's just massive selling across the underlyings. But anyway, right now is a very challenging time for AMCs, right? You're the head of a mutual fund at DSP, and so to speak, you are representing the unit holders, the investors. So how do you yourself and the team ignore all this noise and manage the money?
So how do you ignore the noise? And, for all the reasons that I mentioned, that the world has got so massively connected and information flows very fast, even noise flows very fast. So you need to design filters to figure out what is noise and what is actionable information.
Right.
And, thankfully, in the last couple of years, the team at DSP has, tried to create filters, what we in our internal language call it frameworks. We created investment frameworks. So, we have 2 asset classes that we manage. We have fixed income and we have equities. So we ask this very fundamental question, that what drives stock prices in the near term, medium term, and long term. We being long-term investors, the factors which matter for long-term price appreciation is what we focus a lot more on. And we've designed investment frameworks which say that, if my hunting ground is the underlying benchmark. So for a large cap fund, my benchmark is the top 100 companies. For mid-cap fund, the benchmark is 100 to 250. For small cap fund, it is 250 and beyond. For multi-cap fund, it is the entire 500. So I know my hunting ground. And then we using these investment frameworks, which we have, evolved over time, based on our experience, and then we have tested them. We have evidenced them that, and what are these frameworks? They are a series of hypotheses, like companies which generate, very high return on equity without taking a lot of leverage.
Right.
Diluting equity significantly. With reasonably, shareholder-friendly management style. In industries which have a long runway for growth. Buy companies which convert the revenues they generate into actually cash profits. Minimizing leakages. Not having accounting shenanigans. So there are these multiple factors that we have created, which are our frameworks, which help us eliminate what we should not own and select what we should own, which we believe in the long run can create significant compounding of wealth. So we apply these frameworks and continue to stick to to these frameworks. And the benefit of these frameworks is that the mind does not get swayed by looking at the markets recently. In the last 2 weeks, we have seen markets go down by 10% on a single day, go up by 7% the next day, within the same day go down by 2%. So price should not affect our decision alone. The fundamentals of businesses should determine, and that is what our whole focus is. So I would just say that the value of having investment frameworks for each product strategy is what guides us, navigates us, acts as a lighthouse in stormy waters, and that's what we try to do.
Yeah, and I think that's the definition of panic, right? The definition of panic is not knowing what the future is, not knowing what steps to take. But if you ask someone who's well-trained, like someone in the army or a ranger, they know exactly what to do in certain situations. And perhaps you're that well-trained professional group of people who know what that framework is, what is to be done. And I guess it's just about executing and not about the noise, like you said.
Thankfully, what is also an advantage for a few fund houses like us, we've been around for around 24 years now, starting 96. So as a team, as a company, we've seen 4 market cycles like this of euphoria and pessimism. We've gone through these type of sharp drawdowns in the past. So what we know is that every 8 to 10 years, such sharp price falls can happen, and they could be led by different triggers. But we also know is companies which are survivors, companies which are solid balance sheets, companies which can continue to grow over time through good and bad times, are the winners finally. So our whole idea is to identify and stick to these winners, and they eventually revert back to their deserving price movement, notwithstanding short-term fluctuations.
Right. I mean, we're doing this on our definitive bear market. I think there's no question about it. Everyone says it's the right time to buy. I think we've all heard that before. But what I wanted to understand from you is, what is your view of an investor of what you absolutely not do in the bear market we are in right now?
Okay. So let me give you a disclaimer first. This is like going to a saloon and asking the barber that should I cut my hair or should I trim my beard, right? And I think one important principle that every investor should be aware of is that whenever they talk to experts like us, obviously there is going to be a bias of ownership. That we own a mutual fund, we run a mutual fund, so we want investors to buy our products. And investors should always have a little bit of skepticism when they listen to so-called experts like us.
So honest to say,
no, it's not honesty. It is authenticity. It is about being very aware. And I think some of these rules really will help an investor become a better investor over a long period of time. Number one. Number two, mutual funds always emphasize, and like not just DSC, but a lot of my colleagues in the industry have time and again who have spent a decade or two in the markets have said that diversify your money across asset classes so that when one asset class doesn't do well, your entire portfolio does not go through that bad phase. The other asset class will help you out, and keep your money prudently spread across these asset classes. That is one important rule that we have always highlighted. It's a golden rule. It's a holy grail of surviving in the investment landscape. So asset allocation is very critical. Another important rule is buy low and sell high. Now, unfortunately, in our industry, we seldom advise investors to sell high, because if we tell an investor you sell high, it means the investor may go away from us. But by saying that asset allocate right, what you mean by that is when an asset class is very high, rebalance out of that into an asset class which is not very high. And today there are automated asset allocation funds which actually do this job very beautifully. So what an investor should do primarily at all points in time, in good and bad times, is stick to asset allocation. What an investor should not do, clearly, is not to repeat the mistake. So if most of us have invested at market highs, which in hindsight is a mistake, exiting that money at market lows will be compounding that mistake, and converting actually paper losses which are there right now in the NAV into actual loss. So what an investor should not do is, if he does not need money, if his financial plan is, really well made, if his asset allocation is well designed, and I'll give you my example to explain that. If your asset allocation also is well designed, then it is extremely important to be stoic, to be strong about what is happening right now, and maybe more likely pain in the next couple of quarters, because I don't have an answer when this will, end. So this can last for quarters, this can last for months, this can last for a couple of years as well. An investor has to always be aware that in a journey of 10, 15, 20 years, there always will be 20%, 30% of times when the journey will not be the way I want it to be. And those are the moments to, close your eyes, stay disciplined, stick to your core, and not disturb your asset allocation, or, get out in panic. So that is extremely important. What an investor should not do is break his asset allocation if it has been well designed at the time of investing. If at the time of investing, if we have made an error by saying that, okay, when markets were good, I put all my 100 rupees in equity. Now that markets have fallen, now what do I do? I would say that in that case, you still have to, sell and, create some liquidity and create your asset allocation all over again, because you don't know what the next 6 months or 1 year is likely to be. Markets can fall further. You may need more cash. You may need emergency funding. You can have, salary and job mismatches. And preparing for those emergencies is a more important dimension than you staying invested in any of our funds. So all I would say is that it is a reflection of your time horizon, your asset allocation, and sticking to that. So I'll give you my example. For example, I highlighted that I started investing when in the next 2 years there was a huge 80% price correction in tech funds and tech stocks. And then I've seen the 2008 cycle where there was a 50-60% price correction. So as an investor, I've always been conservative. I've always been a scared investor. I've always felt that, when you start your career by losing money, you don't want to be at the mercy of market swings all the time. And you also know that this is a given. Markets will fluctuate. The most universal principle that an investor should accept is that the job of markets is to fluctuate. Do not extrapolate good times forever and bad times forever. So they will keep fluctuating. In good times, think about what will happen when they go down. And in bad times, think about what will happen when they go up, because times will change and this will pass. So, because of my conservative approach, I have largely always been, when markets have been euphoric, I try to stay 40-50% in equities. I don't increase it significantly. In fact, I had done a session with Zerodha a couple of quarters back, giving a framework that when are markets cheap and when are markets expensive. Valuation is a very interesting, tool to determine whether you are on the expensive side of the market or the cheap side of the market. So today, markets are not very expensive. They've significantly corrected. They are becoming cheaper. They are getting into a zone where a lot of good companies will make a lot of money in the next 5 to 10 years for investors who can stay put. So from my 40% equity exposure, I have taken it to 60. The peak I will ever have for my profile is going to be 75. Because, for example, I don't have a house of my own. I live in a rented house because real estate is crazily expensive. To me, it doesn't make sense to buy real estate at 1 or 2%, yield. So, but whenever real estate turns cheaper, I would like to buy that. So I will always want to keep 20-25% away for a future goal like that. So my net capital is not 100 but 75 rupees. And that 75 rupees I will, allocate between debt, equity and gold, depending on how valuations are in each of these asset classes. So when equities are very high, I will try to keep exposure slightly lower. When bonds are very high, which means when interest rates are low and bond prices are high, you marginally reduce exposure to bonds and move back to equity or move to gold. So those are the variations that one needs to manage as an investor and create asset allocation and then stick to that.
That makes sense. Actually, if we look back at your example of 2008 and let's say we use price to earnings as a valuation metric, for example, as one of the metrics, I think 2008 was 25. This time it went all the way to 27, maybe a little more than that. 2008's lowest was 10.5, somewhere around there.
Absolutely.
Right? Somewhere very recently we were at 17, but now with the bounce back probably somewhere there. So now we know we're probably somewhere in the middle. And you're rightly saying that, don't put everything into equity, but probably balance it out. But if we go crazily below to like a number like 12 or 15 or something, no one knows if it will happen. But if it does, then that's the time where you can allocate a little more to equity.
Significantly.
But the key that you're saying is that you're allocating. You're not putting everything in one. That's what you're saying. Excellent. That makes sense. I think you've spoken and you've written a lot about investor behavior, Kalpen. One thing I wanted to talk to you about, there's this podcast about Daniel Crosby. He's this behavior finance expert. He was saying that humans aren't designed for investing, right? Is that it's very counterintuitive. It doesn't match with who we really are or what our inner voices is or how we evolved as people, how our fear and greed works in our brains, right? So why do you think that is? And why are we so bad at being investing intuitively?
So I think it's a repetition of what I had said again in the Zerodha video conversation I've done, that by evolution, the human species has survived because of running away at the earliest sign of fear millions of years back. So our survival instinct as a species actually comes against us in the investing journey, because at the slightest form of fear, we like to run away. Investing has to be counterintuitive. Investing has to be contrarian, where when there is fear is when prices become sane. When there is fear, prices fall and the risk actually comes down. A lot of people, if you were to ask them that, if markets are falling, is the risk high or low? 99.9% people will say the risk is high. Actually, the risk is coming down. Because, of course, the larger rule is that these prices eventually go up. Because that has been the history of stock markets, that in the long run, prices go up. Unless you are a Japan, unfortunately, where for 40 years prices went nowhere. So these are things that an investor should be always aware of and should learn. One more reason that why I never would encourage, 100% in equity is, for example, there are enough countries where for 10, 20, 30, 40 years, stocks have gone nowhere. Even in US, for that matter, since 1982, bond funds have outperformed equities. So, where are we in the cycle? Where are we in valuations? Where are we in terms of valuations versus earnings? These are things investors should learn and not invest just on narratives that India is growing or not growing. So coming back to your question, evolution has created us in such a way that we are wired not to make money. And hence we have to pause and make a switch in our mind that when should you invest more? There have to be rules for investing. So as an investor, like my rules are when, the underlying has to be good companies, which means obviously, I invest only through mutual funds because, my logic is if I don't get time to read company balance sheets and, keep track of what's happening, and if I'm still investing, then I'm not investing, I'm speculating. So I rather give the job of managing money to my fund managers. It is a given that the underlying companies largely will be good. If that being the case, when the prices fall, I'll invest more. When prices rise, I will invest less because I get salaries every month. So, I have money to invest every month. But I will calibrate. So, there are years when valuations are about 23, 24, where I actually allocate more to my variable provident fund, that VPF, which gives some 8.5% tax free. And, I'm likely to talk to my HR head that now that prices are low, can I stop doing the VPF and allocate more towards equity? Because now you are getting closer to the average and below average. You're still not cheapest, but you're below average. So for a consumer who wants to be a successful investor, he has to first learn these principles, that when do you make money and when do you lose money. And if you know, I think one very interesting lesson I have learned is with experience, with loss of capital and with a lot of, learning from the giants is know when do you lose money. If you know how is money lost in markets, and if you just don't do that, you will make money. It's so simple. So, to make money, don't ask this question, how to make money. Ask the question, how to find information around that. And I'm sure people are Googling right now, talking about bearish news. Positive news. Why isn't it being shown? Is there no positive news? How do investors deal with news inside? Okay, so there is an author who has influenced a lot of my thinking. His name is Rolf Dobelli.
Right.
and he's written an amazing book called The Art of Thinking Clearly. He has a very interesting comment that news is to the mind what sugar is to the body. And there is some research done where he says that consumers, when they stopped reading daily headlines, actually ended up being better investors. And the reason for that is when we look at a lot of news, particularly financial news, news is already there in the price. Because if you and I know it, the whole market knows it.
Yeah.
But what happens is and news has to come every day, right? Newspapers have to come every day. And in today's digital world, a tweet has to come every second. So there is an extra, magnitude of news which is coming to us. And our mind likes to react to every news flow. So it's very counterintuitive. Investing and compounding is an outcome of how long do we invest.
Right.
Time is raised to the power of in that formula of compounding. Now, if you want to really stay and be a 20-year long investor, but if you're going to look at data points every 20 minutes, track prices every half an hour, read every piece of information every day and try to analyze it, even though we are not experts,
Sure.
what happens is that you are killing your long-term compounding. I think Morgan Housel has made this comment that, the first rule of compounding is don't disturb your compounding. Don't interrupt your compounding. And we interrupt our compounding by constantly looking at data points and, news flows and trying to alter our portfolios and constantly being in a state of hyper activity. The more we act, the more we hurt our portfolios. So I feel, one very important dimension is to become a rules-based investor.
Right.
Broadly, once you understand the formula of making money or losing money, create rules that suit you, and then stick to those rules at large. Let's say if my rules are that around a certain valuation range, I will be more in equity, and around a certain valuation range, I will be less in equity.
Correct.
Around a certain price of gold, I will be more in gold or less in gold. Then stick to those rules rather than what news flow will tell. And I'll give you a classic example. In the last 4 days, while I preach all of this to you and your viewers, I sleep nowadays at 1:30 and 2 because the habit of tracking what's happening to US markets today is again become a addiction. So I look at the prices. Then there is a news flow which says that the US government along with the Fed is planning a very large stimulus. So US stocks are up 7 or 8%. The next day, the news flow is more cases of COVID, identified in US.
Down again.
So, how do you react again? So every day you have positive and negative news. So I think investing has to be made news-proof, in my view. Right. Investing has to become rules-driven and not news-driven. Rules-driven will give you better outcomes than being news-driven. Because news change every minute, but rules are long-lasting. Rules are what create finally a successful investing.
Correct. And equity as an asset class is a long-term asset class, right? No one asks ki ek hafta mein kitna degi, right?
Yeah.
As opposed, if it's like that, then how can you have news flow decide from one day to another? So that makes perfect sense.
Pratik, you made a very interesting point. I want to add to that. Let's take the successful companies of the world, whether it is an Alphabet or an Amazon or an Apple or a Microsoft or an HDFC Bank in India or an Infosys or a TCS. These companies have been created over 20, 30, 40 years.
Right.
So the money that we always say that this company compounded at 20% happened because the company was built in 20, 30, 40 years.
Right.
The CEOs or the founders of the company didn't look at news every day and aaj news अच्छा है तो और branches खोल दी है और खराब है तो चलो company बेच दिया मैंने.
Correct.
Investing has to be an owner's mindset, and if you start thinking like an owner, you will do a very different, your behavior towards investing will be very different. I think we treat our investments not like our kids. We treat them as, an affair that, I'll buy them for a few weeks, I'll sell them again in a few weeks. I can even tell you, yesterday I was having a chat with my brother. He's a smart guy, smarter than me also. But he had bought some stock in the morning and the stock was up 10%. And he called me to say that should I sell it? And I said, you do whatever you want. I'm not the best guy to. Because unless you have rules, so I'm not saying trading is bad. Even trading is good. But you need to know that job very well. You need to have your rules. So I would only say that, you define your rules depending on what your strengths are and then stick to them.
Yeah, I also wanted to add over here, like, I think if people like believe that India is going to grow over the next 10 years, I mean, this is a discount party, right? Like, I mean, you should think about it like that and not worry if it falls at 10%, I guess.
So Pratik, there I would say that, why do people generally stop believing us when we make this comment is, see, first of all, for the last 5-7 years, India has not really grown at the growth rate that we expect. So yet, if we keep telling our market and audience that, buy the growth of India, somewhere they feel that, you're saying the same thing again and again. And the authenticity of that dimension is lost.
Right.
So it's very important that I would never position India as a growth story, etc. I would always say that, what is our job as investors? Our job is to allocate our hard-earned money to asset classes which have growth drivers and which are available at reasonable price. Don't overpay. Now, that underlying asset class could be equities, could be global equities, could be fixed income, could be gold, could be commodities, could be real estate. So you need to know how to allocate. So either have a good advisor or yourself become well versed in doing that. So, for me, hence, it's not just about India growth story, because if I have money and today I can invest in a lot of global funds as well, if I'm getting the best companies of the world, also at 25-30% cheaper prices, likewise in India, I would want to, diversify. So asset allocation also means diversify your country risk, diversify your asset class risk. And these are the things that investors will have to evolve. Our industry, starting from us as manufacturers, will have to, make that shift and create more successful investors.
Right. Kalpen, just in 2 lines, so we have a crisp, actionable for people to do. There are a lot of millennials probably listening to this, right? In 2008, I was there. I was trading. I shorted the market. But from an investing perspective, back then, investing wasn't free. It wasn't instant. News didn't travel as faster as we're seeing. Now, everything is maybe 2, 3, 4x, right? Everything's on steroids. For the millennial who's invested, and he probably wants to exit, or the millennial who just wants to enter because he sees it for the first time, what advice would you give them? How should they behave?
Okay, I didn't get your first part of the question. If a millennial wants to exit, what should I tell him?
A millennial who's already entered, who already owns stock, versus someone who wants to enter, how should they behave?
Okay, so I think the rule is very simple. First of all, know what you own. If what you own is bad, don't own it. If what you own is good, which is good companies, good stocks, or good funds, and you have time on your side, don't do anything. This correction will pass. Maybe 2 years down the line, you'll realize, why did I sell when prices were low? So take money out if you need it. Let it be if you don't need it. And for a new investor, I go back to one story which made this switch in my mind. In 2008, I always used to like rising prices because that would give an illusion of success. And I read this story somewhere which said that if you're going to be a consumer of, let's say, hamburgers, or if you're a consumer of pizza, you would want bread prices to actually go down, not go up, because you're going to consume it every week, every month, every day. Now, most millennials have a very long runway of time. So the biggest raw material of wealth creation is time, and they have it in their hand. So it is in their hand not to mismanage that and take advantage of time, number one. Most millennials will be actually in the journey of acquiring units. So if they want to acquire more units, they should actually pray for prices to be lower, not to be higher. So ideally for the next 5-10 years, they should say, let prices be lower. And, once I've completed my journey of accumulation of units, after that, let the markets go up. I'm just, exaggerating this a bit.
Sure.
For millennials, I think they should be excited that they're starting their investing journey in a bear market. A lot of money is made when you invest in bear markets, not in bull markets. Invest when prices are low and wait for the reversion to mean to happen. So I think for millennials, my only message is take advantage of compounding and don't be hyperactive, be still, be patient, and give time to your money.
Correct. And also, I think a derivative of what you're saying is that we shouldn't worry about the bottom or how low the market will go. The idea should be you're in a bear market, start investing. Am I right?
Absolutely.
Perfect. So let's talk a little bit about you before we end this podcast. You've already talked about your asset allocation strategy, but tell me, who are the investors you admire the most?
Okay. There are a lot. See, I have worked in 4 different investment companies. I started my career with ICICI, then Birla, then IDFC, and now DSP. And in this journey of working with 4 asset management firms, I've worked with virtually stalwarts of the investing field, and I've learned from each one of them. Whether it is Vineet here in DSP, whether it was Naren in ICICI,
Right.
whether it was Manish Dangi in Birla, whether it was Kenneth in IDFC. Each of them had their own styles and rules. So, for example, with Vineet, I learned a very interesting thing. He says that in bull markets, I stop meeting companies. I stop meeting promoters because all data points are going to be euphoric.
Yeah.
And actually, in bear markets, I would love to go and meet. Because in bear markets, I can accumulate a lot of stock. It becomes a buyer's market. So that's the way he thinks. With Naren, I learned the concept of valuation and the fact that eventually markets mean revert. With Atul Bole, who is my colleague here in DSP, I learned this whole concept that, why investing in quality companies, even if they are a bit expensive, is one of the holy grail of investing, because companies which can generate 15-20% return on capital and reinvest it again and again. Simple businesses which don't have too many complex subsidiaries, promoters who don't dilute their equity again and again, and reduce the return on shareholders' equity. So these are principles that I've learned from people in my industry, people in the asset management industry. Then thanks to the digital world, sitting in your bedroom, you can learn from a lot of other investing professionals. For example, there's this guy called Kuntal Shah who does a lot of education series in Flame University, in Pune. Just by talking to people like that and reading their thoughts, you learn a lot. So there are a lot of people in the ecosystem outside even my own industry, people who are private investors but have seen market cycles over 25-30 years, and who are happy to share their learnings and insights in a very open way, in a very selfless way. It's a great blessing to be connected with people like this and learn from each other.
Very nice. I think that was a nice story you told of everyone. It's a nice, interesting insight. Any favorite books you could recommend? Everyone sitting at home, at least they can buy an ebook.
I think, when markets are rising, we should read books about risk. And when markets are falling, we should read books about hope, ideally. But let's say, some of the books that I can suggest. See, like I said, I like this book by Rolf Dobelli, The Art of Thinking Clearly. It's a very simple book. It highlights some 55 investing biases, in very, very simple. It's a must-read book. It tells you what information to look for and what information not to look for. What information really matters in investing and what almost does not matter. So that's a good book that I've liked. Another book is that I think everyone should read. It's a bit complex. It's Fooled by Randomness by Nassim Taleb. Because most outcomes are random, but we attribute them to us, or we attribute them to some reasons, and then we form false conclusions. In investing, knowing that what results are out of randomness and what is because of some reason is extremely important. Then,
what about the Black Swan by the same author? Is that?
Yeah. So again, Black Swan is a book that I have found it a bit difficult to read, but again, these are all iconic works by. So maybe just one concept in the whole book can change your perspective towards investing and towards risk. So these are some of the books. There's a book called Zebra in the Lion Country, which again is a very interesting book on how being different than the herd is very important. So the comment that you made that why do most investors not make money? Why are we wired to be poor investors? Because we all behave like herds, and if you want to be different than the herd, typically that book is about a zebra which is staying on the outer side of the herd, but but it is also running the risk of being pounced on by a lion. Because if you are in the center of the herd, you are safe. So you feel you are safe when you are in the center of the herd, but then you don't get the best outcomes.
There's no alpha right there too.
Yeah. So there are many, many books. Once you start reading, you can find your own journey. There are a lot of, behavioral books that help around. So Jim's book is again very interesting. Then Morgan Housel's blogs are outstanding. They talk a lot about stillness in investing and giving time to your investing. They talk, in fact, people like him say that you don't need to invest with fund managers, just buy 4 asset classes through passive products and give time to it. And you will do better than most average investors. So though it hurts our industry, but these diversity of reading is very important. You will get different viewpoints, and then you can form your own personal opinion. There are, Indian authors in the personal finance space. Some of them which investors can start, reading. So there are lots of books which have formed an impression on me and helped me in my investing journey.
Excellent, Kalpen. Thank you so much for your time. I hope, and I'm sure a lot of users will find it.
Thanks. All the best. Thanks. See you.